Okay, good people. So today we start chapter 8, chapter 8 moving into chapter 9. And there is a common theme here as to um, there was an allegation placed by the ilk of Eugene Fama and his followers that really from a usefulness point of view, accounting information is not really particularly helpful because financial accounting information is about the past, is about what has happened. And other than maybe some confirmatory or feedback value, there's not a whole lot of predictive value that can be associated with net income. Especially studies showed that net income can't really be used to predict future performance in terms of cash flows and so on. The R squared for net income in terms of predicting future performance was abysmally low as about 2%. And so most people had kind of given up on accounting. We did talk about why there's been a resurgence in accounting in the form of the move towards value relevance, that we want to provide more of a more assistance to users about valuation. And we saw that in the earlier topic about how that has been supported by a whole bunch of different strands of research and thought, but it's ended up supporting accounting information and the need for accountants to take a bigger role in providing information that is helpful. There may still be a controversy or difference in opinion that people might have with regards to whether accounting numbers are useful for making decisions. Okay, depending on what philosophy you hold, what evidence you are willing to put your faith in, there may be some disagreement about whether accounting numbers are useful for decision making. But what cannot be denied is the fact that accounting numbers play a very important role in executing contracts. And this is a separate line of thinking which sort of imagines a company, a corporation, as nothing more than a nexus of contracts that shareholders provide capital to the firm, lenders provide loans to the company, um, employees are willing to work for the company, suppliers are willing to sell goods to the company, and they're all of these transactions are based on agreements, contracts that are legally enforceable, right? So the lender has certain rights over, and these rights have priority over the shareholders of the company. The shareholders, their rights are described in the share offering memoranda, and they happen to be the residual claimants. Employees are hired by companies, and there are contracts, employment contracts that indicate what the compensation would be to the employee. Vendors offer goods on credit to the company, and there are credit terms which are again indicated in contracts. Very often, a lot of these contracts make reference to accounting numbers. And so one could think of accounting as providing the support framework, the supportive framework for all an efficient execution of these contracts. So that is the subject matter of this chapter, chapter 8, looking at the efficient contracting approach towards decision usefulness. That decisions are not always limited to the act of investing or lending. Decisions can go beyond that, and accounting may have a role to play in supporting such decisions. So we're going to be looking at a bunch of specific objectives. We will be talking about what efficient contracting approach to decision usefulness is all about. Um, The sources of efficient contracting demand. So, what are the instances or examples of accounting information being required in the context of contracts? The accounting policies that would be needed for ensuring efficiency in contracting. We will explore a little bit the concept of contract rigidity and that how that can have an impact on um, companies choosing between or amongst accounting policy alternatives. We will talk about what had happened back in the day when companies were first asked to expense stock options. So controversy around that, because there was an argument made that these accounting policies, they have economic consequences. Um, we will distinguish efficiency from opportunism because one can also argue that sometimes managers, especially top level managers, take certain actions that are more self-serving than in the broader interests of the company. We will look at the concept of implicit contracts and then summarize the implications of this discussion in general for accounting. So starting out with a look at the efficient contracting approach to decision usefulness. Efficient contracting theory argues that the structure of an organization, how an organization is set up, depends on what it would take to execute, to carry out the company's operations or the organization's operations in the most efficient manner. So efficient means smooth manner without any um, kind of disruption or friction, which leads to unnecessary waste, right? So minimal amount of wastage in terms of effort or resources. And we're talking about a the desire to survive in the long run, right? No company wants to fold down, and that desire to continue to operate in the long run is predicated on ongoing profitability. Because a company that's not profitable in the longer run cannot last for very long. So decisions about how much of centralization of decision making should happen or how much of decentralization, as in empowerment of lower level managers, should take place are often made on the basis of what kind of structure will aid in the best execution of the company's or the organization's activities. Whether the company should do important work in-house or outsource, again, depends on the core competencies that the business has. Some of these kinds of decisions you may have learned about in management accounting courses, right? So especially, I think accounting 380, I believe, would be the relevant course at SAIT, where you would have learned about some of this decision-making choices. The capital structure. So should the company be more financed with equity or more with debt depends on a large extent as to the nature of the cycle, the operation cycle that the company has. And there are certain industries which naturally lend themselves to more debt, mining, oil and gas. Traditionally, they have relied on a lot of debt financing. And then, when more recent in the last decade or so, when oil and gas companies found themselves at the mercy, the uncertainty of crude oil prices resulted in wild fluctuations in profitability, and a few of those companies found themselves looking at very, very, very disturbing levels of debt. They have tried to respond by paying down that debt, right? So optimal capital structure is something that, again, is decided upon by companies' management based on what would serve the needs of the organization the best. The form of corporate governance. So corporate governance is a very broad structure. So corporate governance, so if you've set up a company as a as a so if you've set up a business as a corporation, then it's required by law for that company to have a formalized governance structure. And as part of that governance structure, there would be the need for a board of directors. So, how many people should serve on the board? What should be the composition of the board of directors? What kind of variety of experiences and educational backgrounds should those directors have? Who gets to vote for the election of um, directors that represent interests of shareholders? Do other parties like employees, lenders, should they have representation on the board? A lot of this is often defined by the law of the land, right? So there are certain parts of the world, for example, Germany, France, Japan, where a lot of these questions are decided in accordance with the law. In North America, it generally, other than describing how many directors a company should have, usually there's a minimum of 5. There's no maximum prescribed number. There are fewer legal requirements in North America than would be in other jurisdictions. It would also depend on, so answering those questions would also depend on what other companies in the industry are doing, what kind of complementary um, experience is required. So, you could have a company belonging to a fledgling industry, but it can benefit from directors who've had experience running other companies in other industries, but maybe, you could have someone who's spent their decades of their life in the banking sector. You could have a company that's in IT, but maybe having someone with the expertise of the banking industry to advise, let's say, on how they should be structuring their capital requirements might be a big plus, right? So all of that kind of meshes in deciding on how to set up the corporate governance structure. And again, the underlying idea is you want to make sure that the company or the organization has the best chance at being continually profitable and survive in the longer run. Now, the efficient contracting theory itself is that companies are nothing more than a bundle of contracts, individual contracts. Every company enters into many, many, many different contracts with customers, contracts with suppliers, employees, creditors, etc., etc. Uh, very often, the contracts themselves are linked to accounting numbers. So, as an example, you could look at the contract that a company has with a bank, the bank that has lent it money. Very often, the bank will impose what's called debt covenants. And the debt covenants describe the minimum conditions that the company has to meet in order to be eligible for ongoing access to the loans. And some of these covenants are expressed in accounting terms like you cannot have the debt to equity ratio exceed a certain level. So contract could indicate the debt to equity ratio can be a maximum of 2 to 1. Right? So for every dollar of equity, the company can have at most $2 of debt. Right? The debt levels cannot exceed that. Or the company has to make sure that its times interest earned ratio, right, which is calculated by taking the earnings before interest and taxes and dividing that by the interest burden, so that it has to be a minimum of certain number of times, 4 times or something like that, to make sure that the company, remains liquid, the company remains solvent in the longer run. Or working capital ratio, the current ratio, for example, has to be a minimum of 1.5 to 1, stuff like that, right? So they indicate what conditions have to be met for the company to continue to be able to use the loan that the bank has advanced. You think about suppliers. So suppliers will often extend credit terms, such as 210, net 30, or net 60, etc. Uh, but they may have a requirement that the company, um, especially larger suppliers, might insist that the company um, publishes audited financial statements. They want to make sure that they receive a copy of audited financial statements from the company, especially when you're dealing with private companies, because private companies don't publish their financial statements for general consumption. And so, as a vendor, if I want to continue to extend credit to this company, I want to make sure that my interests are protected. So I want information about the company. Employees, top level employees usually um, will, in addition to salaries, there are contracts in place where they are um, offered bonuses, and those bonuses are very, again, linked to targets that are expressed in accounting terms. Yeah. So these are, there can be other examples as well about how accounting can play a supportive role to ensure contract execution. So, what's the role of efficient contracting theory, if you think about it? Um, because these different parties to contracts have different levels of access in terms of when they receive the information, so timing, how much of detail do they get? That's the quantity of information, quality, and so on. There is the issue of information asymmetry that we've looked at in earlier chapters. So, due to the existence of information asymmetry, uh, incorporating certain basic information, accounting information that has to be shared amongst the parties, helps in ensuring that these parties are able to carry out their activities and be assured that they're not being shortchanged manner, right? And so therefore, accounting helps as almost like WD-40, some kind of a grease that keeps the wheels moving, uh, without any sort of friction, in an efficient manner. Now, efficient contracting theory does acknowledge that there is a role for markets. And we will look at the need for regulation, right? So the why is there, an indication of how much, um, why do uh, reporting standards insist and have a requirement of the minimum amount of information that has to be provided or included in financial reporting? Why do we not leave that to companies? Why do we not leave that to the market forces? We are going to consider that in chapters 12 and 13 later on. So efficient contracting theory does acknowledge that there's a role for financial markets to determine how much of information, financial information, can be prepared and shared by companies. So it does see some role for standards, financial reporting standards, and the role there is just to provide a general direction, general principles, about what sort of information would be useful for a broad array of users. But we also acknowledge that financial information, financial reporting is just one of the many other sources of information that people have about a company. And for the most part, because financial statements are shared, published by companies only after a thorough audit has been conducted, by necessity, financial reports are historical and they talk about a time period that, well, the time period has passed a fair bit of time back, right? Audits take 2 to 3 months to happen. So for a company to share its financial information for a year, the year that ended December 31st, it's very common for the annual report to actually be issued sometime towards the end of March. So already the information tends to be fairly stale. So in terms of currency, in terms of providing information or guidance about the future, it's unlikely that financial reporting will have that kind of saliency. So for the most part, financial statements have more of feedback value. They help confirm or disconfirm expectations from the past. So at best, what people can do is use the information, the confirmatory value of the information to fine tune their expectations about the future, but not necessarily base their future expectations on accounting numbers. Now, we do make assumptions about human nature, and one of the assumptions we make, sadly, about individuals, and managers are individuals as well, is that they will be rational, just like investors and lenders. Investors and lenders are rational, self-interested, utility maximizing. Managers are also individuals, and they will also act in their own interest to extend and enhance their own interests. And so it is possible that sometimes managers will act in a manner that is contrary to the best interest of investors, especially if the manager's self-interest is at a loggerhead with that of, and therefore we acknowledge the possibility, or rather the inevitability, one could argue, depending on your worldview, whether you see good in other people or you inherently see people as, if you regard people with cynicism, you would argue that such conflicts are bound to arise. That people, if you put people in charge, right? Shareholders are the owners, but managers are the ones, right? The CEO and the top teams are the ones that run the company. And in theory, yes, you have shareholders being the owners, but these owners are so far removed from the goings on at the company that managers are really the ones that are calling the shots. And managers have access to current information about the company. Often shareholders don't even bother to find out what's going on as long as they continue to receive dividends or the stock price continues to do well. Shareholders often don't even bother to look up what's actually taking place. That it does create ripe circumstances for people, the top management teams, to start acting as if the company belongs to them, and they start maximizing whatever it is that they can extract from the company, right? And that can be in the form of compensation, right? Get more pay, more bonuses, stock awards, etc., as well as general perquisites, right? Have the best of corporate jets to travel in, put up in the best hotels, go to the best venues for conferences that may or may not be very useful, spend tons of time on golf courses, etc., because that's the good life. And who knows who will go and tell the shareholders? Corporate governance, you can argue the board of directors should be the ones keeping an eye, but the board of directors very often doesn't meet very regularly, meets maybe once every 2 months. And the board of directors often have people who have served as top officers in other companies. So they are accustomed to seeing other people like them living the good life, and they see nothing wrong, right? So in overall, you could see some pretty nasty, um, extravagant spending tendencies that come from management having too much of power and not enough oversight. And so when you have such a conflict, people start caring. And so one piece that efficient contracting does is help us make certain kinds of predictions about when accounting reporting standards undergo a change. Whenever there's a new standard that comes out, how companies management will respond to that new standard. We will look at why managers will often say no, they'll have objections to certain new standards. One example that comes readily to mind is the recent leases standard, right? IFRS 16. Under the new leasing standards, from a lessee point of view, so lessee is the company that's leasing the asset from the lessor, right? Renting it out from the lessor. Under the current leasing standard for IFRS, um, a lease is automatically, it's got to be recorded on the balance sheet. So the lessee has to record a right of use asset and a lease liability. Previously, there used to be certain classification criteria that had to be applied in order to determine if you were dealing with a finance lease or an operating lease. Now, from a lessee's perspective, all leases are basically finance leases. There's only two exceptions, and the exceptions relate to either the short durations. If a lease is of short duration, i.e., less than a year long, that may be an exception, or if the asset, the leased asset, is of low value. Low value is not defined, but in Canada, we use $5,000 as an indication. So if if the leased asset is less than 5,000, one could apply an exemption and say, let's treat this as an operating lease. Otherwise, all leased assets have to be booked. Now, if you think about the accounting repercussions of that, from the lessee's point of view, it does have a negative impact on the debt to equity ratio, right? So there was huge pushback when the standard IFRS 16 was in the discussion stage. There was massive pushback from a lot of preparers saying this will just add to the burden for companies, etc. Accounting wise, it will be more challenging, yada, yada, yada. However, the IFRS standard went through. ASPE still has the classification criteria. For smaller companies, they are able to, as long as they structure the lease um, in a way to, that they're able to bypass the classification criteria, private companies don't have to record the lease as a capital lease, a finance lease, if you will. So there are other examples that you will likely encounter in the future, and there are examples from past as well, where there has been conflict, there has been pushback against certain reporting standards because they have an implication for the company. We are able to design contracts in a way that we are able to somehow mitigate the inherent conflict that exists between the interests of the shareholders and the interests of the users. And we will be looking also at, or efficient contract theory um, speaks of implicit contracts So implicit contracts, an example of an implicit contract in IFRS is um, so there are, if you think about liabilities, right? So there are liabilities according to the law, and then there are expectations that in general, right? So there's the term in IFRS is called constructive obligation. You might have heard of that term, constructive obligation, where there is no legal requirement, but just because of general practice, a company is expected to do certain things that go above and beyond the minimum legal requirements. So constructive obligation, an example from Costco, let's say the Costco retailer, would be that customer has to be satisfied. So Costco will often stand, you know, behind the product. You don't like the product, doesn't matter what it says on the receipt, you can bring it back and they will often give you a refund or replace the product and so on. So you may have seen this in your life as well. They will often go above and beyond what is mentioned on the receipt. And that is just to make sure that the customer does not walk away feeling that the company um, did not support its promise, right? Did not support its product. So efficient contracting thinks through and actually predicts that there will be instances where a company may have to go above and beyond the basic expectation of market participants. So looking at the sources of the demand for financial accounting information in the world of efficient contracting, primarily the demand comes from two sources. No surprises there. There's lenders and there's shareholders. Of course, lenders are concerned about the security of the money that they have lent the company. They don't want management to borrow money from the banks or other sources of debt financing and then just use that money to pay out dividends to shareholders and use up the rest for their own perquisites and well-being, right? That could happen. That's basically the classic Ponzi scheme. You keep getting some additional idiots all the time, and everybody's happy, everybody's blissfully unaware. Lenders are concerned about that happening because they don't participate in any additional profits, but they do bear the risk of losses. So very often, lenders will not lend anything without um, without some kind of collateral. So debt for companies is often secured. Most bonds and so on will be secured. If a bond is not secured, it's actually called a debenture. A debenture, by definition, is something that is unsecured, and unsecured debt will typically be compensated for in the form of higher interest rate. Okay? So lenders will often impose debt covenants, as I mentioned, just so that it gives them an early warning if there's going to be any issues regarding the company's stability, solvency, liquidity issues, and so on. The lenders to the company want early warning of such difficulties so that they're able to take whatever steps are necessary to protect their interests. On the shareholders' part, yes, sure, they are residual claimants, but they're not there. For the large companies, shareholders are not there to oversee whatever is happening on a daily basis. Unlike a small company, right? A small private company, there are few owners, and usually the majority shareholder also happens to serve as the company's president or CEO, and they're there every day almost on a daily basis. So, in that case, for a private company, the owners are also running the show. They're also the managers. So there is no conflict of interest as such. But whenever you're talking about a large company with hundreds and thousands of shareholders, those shareholders, A, their shareholdings are very small, and B, they're not taking an active interest in running the company, or let's say they are not able to. In that case, they run a real risk in the form of moral hazard from the management, right? Management, because the management has free reign over the company, management can end up taking actions that are against the best interests of shareholders. Managers can take excessive risk, for example. If managers are paid bonuses and bonuses are linked to profits, managers can literally take gambles because it's not their money at the end, right? If the gamble pays off, you know, the managers will reap huge bonuses. If the gamble does not pay off, well, hey, it wasn't their money to lose anyways, right? It's the shareholders' money. So there have been instances where companies have lost shareholders' wealth spectacularly, just because there were a few rotten apples in the management team that chose to take that excessive risk. Um, so on both counts, both shareholders and lenders require regular reporting of accounting information, and they don't trust managers' words for it. They require audits. So audits add a veneer of credibility and assurance to the financial information. All right, looking at accounting policies that would be needed to ensure efficient contracting. We want accounting policies that enhance reliability. Now, this is different from the decision usefulness approach that we saw, or the valuation approach that we saw. There, it was more about relevance, right? So, decision usefulness approach said accountants need to make sure that they provide information that is relevant. And for relevance, the information needs to have predictive value, needs to have feedback value, should be material, etc. Right? So there are certain aspects of relevance that help enhance the usefulness of information to decision makers. Efficient contracting takes a back step from relevance and says, hey, relevance is often right now no longer as per the um, conceptual framework of IFRS. Timeliness is no longer part of relevance. But if you think about ASPE, ASPE still has timeliness as being an essential component of relevance. In the past, companies used to be in a rush to publish their financial numbers because they thought, oh, we need to make sure that users get the financial information while it's still fresh. That's a lot of good that did, because very often when you're in a rush to publish the numbers, you're cutting corners in terms of reliability, you're making estimates. And those estimates, if they don't end up being good estimates, well, you're essentially spewing out garbage to the users. And that didn't help anyone. So there has been a movement towards saying accounting numbers can never compete against forward-looking information. So if someone wants to see where the direction that, let's say, Nordstrom is going, well, Nordstrom is closing shops in Canada, you didn't have to actually wait to watch or take a look at Nordstrom's annual reports. You could have easily, for the last year, analysts, or if, let's say, you were potentially interested in Nordstrom, you could have just gone to some of its stores and seen what the foot traffic was. My guess is lots of people doing window shopping, looking at stuff, but very few people buying. At least that was the impression I got when I went to a Nordstrom store. And so when that happens, you don't really, see much of a hope. Like uh, you get a sense things are not going well, right? And so bad surprise that they're moving out of the market. So users would rather have reliable information, right? From an efficient contracting point of view, users will rather prefer reliable information. So especially for a lender, right, a bank or a bondholder, they're not going to get extra money if the company does really well. But if the company does poorly, the lenders stand the risk. They face the risk of actually losing, right? The company goes bankrupt. They might not, the lenders might not get back the money that they lent the company. So lenders are more interested in bad news, right? So I'm not saying they're looking exclusively for bad news, but they would rather get information about bad news sooner than they would be overjoyed with the good news. Because the good news part, from a lender's point of view, if I've lent money to a company at 5% interest, the maximum I'm going to get back from the company is my 5% interest and my principal amount when the loan matures. So if a company is doing spectacularly well, good for them. I'm only going to get my 5% interest. But when I hear the company is doing poorly, now then I start worrying because I don't know if the company will have sufficient cash or income to pay my interest. If it doesn't and it falls behind, what happens, right? If things go really, really, really bad, I could find myself standing in queue, over the company's assets. If the company files for bankruptcy and the company has many other lenders, creditors, I will be very worried about where I stand relative to the other creditors, because not everybody will walk away with the full amount that they're owed. So, from a lender's point of view, they are more uh, interested in learning about what things can potentially go wrong, right? So they are um, inherently pessimists. Lenders are inherently pessimists with regards to financial information, and they are very keen on learning about bad news if there is any. So, in order to be reliable, they want reliability as well, right? Lenders need to make sure that the information they're getting is reliable. Um, it is important that whatever information that a company shares with outsiders is based on realized market transactions. Notice how, we're kind of shying away from the fair value preferences uh, that the decision usefulness approach had, right? Provide fair value information. Well, for the lenders, if those fair value numbers are not reliable, they would sooner disregard them, right? So if you are going to be providing fair value information, ensure that the fair value information is closely aligned with actual realized market transactions or quasi market transactions. And these numbers should be capable of being verified. Verifiability is an important consideration for reliability. In the IFRS conceptual framework, timeliness, verifiability, they are part of the enhancing qualitative characteristic, right? Whereas in the ASPE conceptual framework, verifiability is an essential part of reliability. So carrying on that vein, reliability from an efficient contracting point of view, um, we consider changes in fair value as generally unreliable, especially if the fair value numbers are not based on market prices. And very often for the fair value information that companies will present, especially for um, asset values like equipment value, land value, and so on, very often there are no ready markets for such assets, and they are based on estimation. And when you're dealing with estimates, sometimes there can be honest mistakes happening. Sometimes managers are motivated to provide a biased number, a number that will help make the organization look good. And the numbers are hard to verify. However, at the same point in time, if we see fair values as reflective of what the organization is worth, right? Even with an element of um, lower reliability, one could make the argument that the value of the organization reflects the quality of the job that the managers, top managers, have done in husbanding or managing the resources that they have been entrusted with. So the stewardship, assessing the quality of managerial stewardship, one can do that by looking at the fair value of the company. So in order to balance those two objectives, right, to balance those two objectives, um, you have to walk a very thin line, right? So on the one hand, you have investors, shareholders who are interested in the longer run growth prospects, etc., because that's the only way they'll make money. Whereas the lenders, the creditors, they are more interested in the protection that they have with regards to the money that they have lent the company. So the financial statements that will suit the needs of lenders, creditors, may not be the same as the financial statement information that provides information that's best suited to shareholders. So there's always been this tussle. Who should we privilege more? Who should we target more when it comes to presenting financial information? And that's a question that's very difficult to address because you always got to balance out. And when you consider the role of financial standards, reporting standards only hope to or only seek to make sure that there's a level playing field, that everybody gets access to a certain minimum amount of information, right? There can always be improvement in the quality of information that is prepared by a company. But since you cannot suit everybody's needs, you cannot meet everybody's needs, there's got to be a compromise. How are we doing so far? Any questions on the chat box? Not really. Okay. So we want reliability. That's an important. What we also want is numbers that are conservative. Right? So we need conservatism. And conservatism is basically about making sure that you're not overstating the assets or the income. So do not overstate assets, do not overstate income. We're not talking about understating deliberately, right? But we want to make sure that we are not overstating asset values or income. And we have looked at the need for impairment tests in the past. So impairment tests provide an early warning about, you know, a potential future financial distress that a company might face. If a company's got to write down its assets because they've gotten impaired, it's an indicator that whatever the company was expecting to be able to recover from the asset, it now believes that it's not able to, right? Hence, it had to write down the asset. So conservatism requires that we do not overstate asset values. That is why if an asset is found to be impaired, right, when the carrying value is greater than the recoverable amount, we write that asset down, right? So for a lender, the impairment test ensures that the asset values are reported at the lower bound of how much the company expects to recover from those assets. So gives us good sense of how secure the loan is as far as the lenders are concerned. And then we talked about conditional conservatism, the need arising from auditors, because auditors felt that they were exposed to litigation, right? If a company, even if there is no current indicator of any kind of loss of value, if there is a possibility in the future that there could be a decline in asset values, auditors have started asking for companies to make such projections, determine what the potential loss in value would be, and take a write down now. That's conditional conservatism. It's especially true for financial instruments, for banks, let's say. So if you've been watching the news recently, all of the top banks have indicated that they have put aside money for loan loss provisions. So even though the quality of credit for Canadian consumers is still okay, banks have started worrying that people will start falling behind on their credit card payments. Next to follow might be their mortgage payments. And when that happens, there can be a crisis. And so a lot of the banks have already started to put aside billions of dollars just to anticipate something like that happen. Right when COVID hit, banks took large amounts of loan loss provisions because we didn't know at that time whether consumers, individuals would be able to carry on. Of course, the federal government kicked in at that time, came up with CERB and all the other assistance. Now there's no more CERB. So this will be the true test, with the increasing interest rates, inflation. Um, the job market continues to be hot, but if that starts softening, then there is a real chance that things could go sideways. So auditors must have played a big role in ensuring that banks do a thorough job of projecting. So even if, so Harjinder is right now paying his credit card bills, he's paying his mortgage, but the banks have to ascertain based on Harjinder's profile, whatever information they have, and they can always pull up Harjinder's credit information. They can see exactly how many credit cards Harjinder has, etc., etc. They then run models about what's the possibility. Maybe Harjinder, there's a 5% chance that he will fall behind his. So what the banks will do is based on their net exposure. So say if Harjinder has a mortgage with RBC, RBC will put aside 5% of that mortgage or some calculation that they'll do to put aside, okay, so if Harjinder does fall behind, what would we be looking at, right? What would RBC be looking at? Like, of course, RBC does not want to foreclose upon Harjinder's property right away, right? That's not what the banks want to do because what are the banks going to do with a lot of houses all of a sudden? But the banks also don't want to be in a situation where, the value of the asset that the mortgage is backed by falls below the mortgage because then the bank is looking at potentially huge amounts of losses. So conditional conservatism is pushed upon companies, um, typically by auditors. And again, the idea is if company management is made aware of the possibility that there could be losses, they will likely take actions to avoid it, right? So early recognition of losses can help motivate managers to kick into an action mode. Sometimes, managers try to avoid taking actions when action ought to be taken. And if they act and when it's too late, then by definition, it's too late, right? So helps keep managers in line. Contract rigidity. This is a very interesting piece. So yes, companies are a bundle of um, contracts. Now, the thing with contracts is like in a general sense, we don't live in under ideal conditions, right? One of the hallmarks of ideal conditions is even when you have uncertainty, ideal conditions of uncertainty, the definition of ideal conditions is whatever are the future states of nature, all possible future states of nature can be described, and there are probabilities related to each future state of nature. Those probabilities are not subjective, but rather objective, right? They are not dependent on the person making the decision, but these probabilities are based on observed evidence. Real life is nothing like ideal conditions. In real life, number one, it is next to impossible for us to forecast everything that can happen in the future. We just can't do that, right? Impossible. To boot, to assign a probability to even the possible states of nature that we could describe, those probabilities are often dependent on the person who's making that judgment, and they're not objective. So, by definition, the conditions under which contracts are written, they're not ideal. We don't have complete knowledge, foreknowledge of what can happen in the future. So by definition, the contracts that we write, if you think about the legal language in a contract, the contract indicates that if something goes wrong, such and such would be the recourse that the parties have. But since we cannot anticipate everything that can happen in the future, our contracts are by definition incomplete. They're incomplete in the sense that the contracts do not talk about every possible future event and what needs to be done if something were to happen. We will have some general discussion, but we cannot forecast everything that can happen. So, by necessity, contracts are in the real world incomplete. However, once a contract is signed, the two parties are bound by the terms of the contract. So unless these two parties are willing to work together with each other in case something comes up that they had not anticipated. Think about COVID, right? COVID was out of the blue, it hit us all. Now, at that point in time, the banks, the lenders, right, the banks were willing um, to push back to allow people deferrals of mortgage payments, right? So they gave people extended bit of time. Okay, if you can't make your mortgage payments, that's fine. They did not, of course, forget about the loan. They just kept adding the mortgage payments to your mortgage. And so, you over time, you will end up paying more interest and so on. But at least in the short run, the banks were willing to work with the borrowers, right? The mortgage. If the banks had said, no, you signed the contract and you're supposed to make your mortgage payments regularly. If you fall behind on your mortgage payment, we'll come and foreclose upon your property. Well, in that case, and if let's say the federal government had not stepped up and started sending out sort of checks, it is possible that we may have seen a lot of people, good, hardworking people, lose their houses because they just could not stay current, right? So what we saw happen was parties, including the banks, being flexible under the circumstances. Had they chosen not to be flexible, if they had stayed not flexible, not willing to change, well, that's rigid, right? So if the parties to the contract don't, they want to stick to the letter of the contract, then we have challenges. That's basically what this contract rigidity is. For a company, there are economic consequences. So when we talk about accounting policies, the people in the world of finance say, hey, cash flows is what it matters, right? So if you have accounting policies don't affect cash flow. Let's give you an example. Think about um, an inventory policy of either first in, first out, or weighted average, right? Those are the two possible inventory policies. So for a company that, let's say, merchandising company, right? So for a merchandising company, when they buy inventory, doesn't, regardless of which, whether they use FIFO or weighted average, the cost of the inventory to them remains the same, right? What they buy, what they pay to buy the inventory, the cash flow related to that purchase, or the amount that they sell the inventory for, right? The amount arising from the sale, those cash flows are not dependent on which policy they used for inventory. However, the amount that they report the inventory at on the balance sheet and the dollar value for cost of goods sold expense that they record on the income statement, which then has an impact on the reported net income, depends on the inventory policy. So in general, if you consider any example of an accounting policy choice, accounting policies do not affect cash flow. People who stand behind efficient securities markets say, as far as markets are concerned, they should be able to see through the impact of a company's accounting policy. And therefore, it should not matter whether company X follows FIFO, whereas company Y follows weighted average. As long as the markets know what the accounting policy is, they should be able to see through the impact, right? So yes, we know that in the period of inventory prices that are going up, using FIFO would mean a lower cost of goods sold, because you're assuming goods that were bought first were sold first, and therefore the result will be higher profits as opposed to weighted average. If, on the other hand, prices have been falling, then FIFO will result in a higher cost of goods sold and therefore lower profit. Big deal. As long as markets are aware of what accounting policy the company is following, it should not matter. However, it has been shown again and again and again that actually what accounting policy is followed matters for a company's stock price. That is what is termed as economic consequence. So when managers of a company respond to accounting policy choices, in terms of either changing their accounting policies or changing their operating decisions in response to a change in accounting standards, we are essentially dabbling in the world of economic consequences. So what gives? What's happening? There's a couple of things at play. Imagine a company that has a loan where there is a debt covenant in place. Now, when the company signed the loan debt covenant with the bank, the company, let's say, committed to making sure that its debt to equity ratio will never rise more than 2 to 1, right? So no more than 2 times debt compared to the equity. Now, say that company is very, very, very close to hitting that 2 to 1 debt to equity ratio. So say right now it's at 1.9. If there is a new accounting standard, let's say there's a new leases standard, which says if the company enters into any kind of lease arrangement, the company has to record the lease liability and a corresponding right of use asset. So the lease cannot be treated as an operating lease. It has to be capitalized. Now think about the cash flow. For the lease, the cash flow is the regular annual or monthly lease payment that you make. So doesn't matter how you account for the lease, whether you account for the lease as an operating lease or as a finance lease, the cash flow remains the same, right? So people who believe in market efficiency will say it doesn't matter whether you're capitalizing the lease or not. So think about the accounting now. If, as per the new accounting standard, the lease has to be recorded and there's got to be a liability recorded for the lease, the result will be that the company's debt will go up. And with the debt going up, the company may hit or exceed its 2.0 debt ceiling, right? Its debt to equity ratio was forced by the contract, the debt covenant with the bank, to be no more than 2.0. So if this company runs the risk of hitting that debt covenant, then the managers of the company would be concerned. Because what could happen if the company, let's say, hits that 2.0 or exceeds the 2.0 debt to equity ratio? On the bank side, the bank will now have to act in response. Very often, what the bank will do is the bank will issue a letter, right? The bank will issue a letter of waiver of conditions. But sometimes the bank may be undergoing an audit themselves. And the bank managers have clearly been told, do not issue a waiver letter. If there is a breach of a debt covenant, then the repercussions should follow. And usually what happens with a bank is if, let's say, a borrower breaches a debt covenant, right? So if the company here hits that or exceeds that 2.0 debt to equity ratio, one of the first things that could happen is that their interest rate might be reset. So the interest rate, maybe currently they're paying prime plus 2%. That could get bumped up to prime plus 3 or 4 or 5%. Interest rate goes up. Now, if you ask me, what happens, Harjinder, if the interest rate goes up? I'm going to ask you back right away. Well, what would happen if your interest rate went up? Your payments will go up, right? Even if your payments don't go up, your interest expense portion will go up. If your interest rate goes up, if you look at what's happening in the mortgage markets, certain banks, they're not increasing the payments that people have to make, but the total amount out of the mortgage payment that people are making, a much larger chunk is now going towards interest than towards the principal. What does that mean? From an ongoing perspective, that loan either is going to be around for much longer, whatever, right? I mean, there may be an immediate cash effect, may not. But think about the income effect. If your interest expense goes up for the company, if the company's interest rate goes up, the interest expense is going to go up. If the interest expense goes up, the net income of the company will fall, right? So net income falls, the result is going to be a smaller amount of equity to be added, which is going to compound my problem because my debt to equity ratio is going to be even worse. To boot, the lower net income is going to translate into a lower earnings per share number. Lower earnings per share number is going to be now seen by the market participants as indicator of poorer financial performance. If investors, the broad investor community sees the lower EPS as indicative of poorer financial performance, a lot of the investors might decide to sell the shares or certainly not invest more. The result is drop in stock price. Drop in stock price has a negative impact on shareholder wealth, right? My cost of capital has gone up because my interest rate went up. If cost of capital is linked to my ability to invest in future projects, and I'm kind of trying to draw parallels here for those of you that remember net present value capital budgeting. if the company's cost of debt goes up, the weighted average cost of capital goes up. Weighted average cost of capital goes up means net present value of future projects will go down. It is possible that the company may not be able to invest in certain projects because the NPV is now turned negative. Overall, then, the economic outlook for the company, the growth prospects for the company start shrinking. As the growth prospects start shrinking, market participants pay attention. They say this company doesn't have a good future. Stock price goes down even more. And if I can carry on this story for a long time, but the bottom line is that all because of the simple fact that the company had to record the lease as a liability, which kind of created this domino effect of a chain of events that followed, even though the actual lease itself did not have any cash flow effect. What resulted from that accounting treatment, right? Having to capitalize the leases resulted in negative repercussions, negative consequences, which are real. Net income went down. If managers were paid bonuses based on net income, the lower the net income, the lower is the bonus that the managers receive. So it does matter, right? One can't say, oh, there's no cash flow effect. Well, it is going to result in consequences for other people. Yeah. So that's the story of economic consequences in a nutshell. So one tiny little thing has a much wider ramification, right? So if you think about economic consequences as, if managers are making choices for accounting policies, and they're trying to, so, before IFRS 16 came out, I was telling you there were managers that were writing comment letters, protesting against the new standard, saying, oh, it's going to impose hardships, et cetera, et cetera. Some of them could very well have belonged to that camp of companies that were very perilously close to their, debt to equity ratio limits. They could foresee if something like this went through, even if there's no cash flow effect of the accounting policy, it is going to lead to other results. And so one could argue that if managers have a keen awareness of what a reporting standard can do to the company, and given a choice, if managers decide one accounting policy over the other, maybe that is an indicator of them exercising whatever choices they have, whatever menu of choices they have at their disposal to ensure that the company does not run into trouble in the future. This is just an indicator of managers showing their awareness and their proactivity towards their proactiveness towards uh, making sure that the company does not end up in default of any technical covenant restriction, et cetera, et cetera. So that's good. But at the same point in time, if the sole reason why managers pick one accounting policy over the other is to simply hide the fact that they themselves are inept, then they're not doing anybody any favor, right? They're simply trying to maintain an outward appearance of, oh, we are a great company, we're doing really well, but in reality, you're not, right? So whether picking one accounting policy over the other was to make sure that the company does not fall afoul of any stupid debt covenant, or managers are trying to hide behind that accounting policy choice, their shortcomings as managers. It's hard for people to tell from outside. Hence, there is this sense of distrust that people often have with regards to when managers claim, oh yeah, all hell is going to break loose, people will often look at them with distrust because they don't really think they're being truthful about the whole matter. This part I think I've already talked about, that if there's no cash flow effect, it should not matter. Accounting policy choices should not matter. However, managers do care about accounting standard changes because of the fact that contracts once signed are hard to change. So contracts, they're difficult to change, therefore rigid, inflexible, right? Rigid means not flexible. It is in theory possible for a contract to be renegotiated. We've seen that happen, right? So that example of what happened during COVID, it's a real example of how it is possible for all parties to come together and renegotiate. But oftentimes in regular periods, COVID was an, an aberration almost. But if you go back to normal times, when lawyers are involved, usually whenever you have renegotiations, lawyers get involved. Lawyer fees are very high, right? So contract renegotiations tend to be costly. And very often people get into arguments, they want to come out with the feeling that they won special concessions and so on. And that can often result in these discussions being very lengthy as well. And I mentioned that at the time of writing the contracts, it's impossible for us to anticipate everything that can go wrong. So that leaves us with these contracts that have to be abided by to the letter, because otherwise the law will dictate, relief. If let's say the two parties have, went to a court of law over a contract, the court of law, the judges will basically require the contract to be met to the letter, right? So that contracts are very difficult to change after you've signed, and you probably have experienced that in your personal lives, especially if you're looking to change your cell phone plan or something like that. Very often they'll come back and say, oh, as per the contract you have to pay breakage fee, etc., etc. Sure, you can call customer service. Sometimes they will waive it, but very often they don't. I personally had a thing with, just prepaying my mortgage by 5 days. They were asking for almost $2,000 extra. And basically they said, just wait out the 5 days. It's easier that way. you know, it sounds very stupid, but very often that is a reality. Accounting standards don't change very quickly, but they do over time. And when accounting standards do change, such as we saw, the example of leases, the leasing standard did undergo a change, and that change could have a result in terms of the effect on net income. Even if there's no cash flow effect, can affect net income. And the changes in net income can therefore have an impact on your covenant ratios. So what is the only way out there? We need to give managers some flexibility with regards to accounting policy choice. Problem with such policy choices is hard for us to say for sure whether the choice that the managers are making is in the best interest of everyone concerned, or is it to protect their own interest. So that's leaving the door open for conflict, that subject matter of chapter 9 essentially. So facing contract rigidity, the company's board of directors need to sort of decide how much of leeway they're willing and able to provide to managers with regards to available accounting choices. if, let's say, the company defines the accounting policies that are available to managers, right? Then it's going to limit the ability for managers that are trying to act opportunistically. Opportunistically is generally seen as in their own self-interest, right? They're taking the opportunity to promote their own self-interest, but it will often will also have the result of reducing the flexibility available. Now, maybe not so much for a company, but sometimes we've seen this happen for governments or not-for-profit organizations. For example, if a government commits to a balanced budget, right? In theory, it sounds really good, right? The company should, the government should endeavor to work within its means, right? Every household does it, so why not the government? What is true for a household, right? So it's generally seen that any household should try to live within its means, right? So try to spend only as much as it earns in the longer run. Otherwise, it is going to go bankrupt. But that's not necessarily good advice for a government. If a government commits to a balanced budget, then especially when it's faced with a time of lean economic activity, when taxation revenues are going to be lower, if a government goes with a commitment to a balanced budget, then it would not be able to provide the services that that are required. If tax revenues fall, overall revenues for the government are lower, and the government says we are only going to work on a balanced budget premise, they will not be able to provide the economic services. Plus, we would be ignoring the potential uh, for the government to sort of revitalize the economy, right? So the government, if government does some additional spending, and that's the Keynesian view, that when the private sector is kind of on its way down because of a depressed economic condition, if the government spent money, it can provide a bit of a fillip or boost to the economy, and that can bring economic activity back into motion. If the government doesn't do that and stays sort of rigid with the policy of ensuring a balanced budget, then it can result in this vicious cycle of bad economy resulting in even poorer economy, even poorer, etc. Right? So that's just one example that you don't want to limit the available policies for people who are running the organization. But if you give too much of choices, then that too could result in behavior where the managers will pick those accounting policy choices that will suit their interests the most. What is the happy medium? Impossible, right? That is the hard part to answer, because everybody, in theory would like to be in that Goldilocks zone, right? Neither too hot, neither too cold. But what is that right sweet spot is very difficult for people to actually discuss. Bottom line then, in spite of or regardless of how much of accounting policy choices are available to a manager, the changes in those accounting standards do matter to managers. And if managers' hands are tied, if they are not given some leeway with regards to accounting policies, managers might resort to earnings management through real earnings management. For example, if managers um, have to make sure that the net income number meets some target that has been imposed by an outside party, and if they don't have any ability to modify accounting policies and achieve that purpose, well, then managers will try to increase reported net income by cutting back on um, expenses. So the example on the screen says if they start cutting back on maintenance. Now, if you cut back on maintenance, we know the accounting result is maintenance expenses lower, income is higher. But think through, you cut back on maintenance, you're potentially exposing the company to a greater likelihood of more frequent machine breakdowns, and that's going to have negative impact in the future. So give people some breathing room, right? Some flexibility. That's basically what this entire discussion was about. Give managers some breathing room. As far as the stock options bit is concerned, it's really old story. So in general, now you folks have all likely come from intermediate two, and you would know that stock options are expense, right? So when a company uses stock options as a compensation device, the company records an expense and over the vesting period, and that's about it, right? So there is a charge against net income. In the past, that was not the case, right? In the past, there was no need to expense stock options. And the argument was that the stock options are issued, they can only be exercised at a certain strike price that is usually higher than the current stock price. So they don't have any intrinsic value. Intrinsic value is the difference between the current stock price and the exercise price on the stock option. So the argument went, since intrinsic value cannot be negative, right? By definition, intrinsic value can be on the lower bound 0. So say a company issued stock options at a strike price of $15 and the current stock price is $10. Intrinsic value of each option is 0, right? Because the executives will only be able to buy additional shares at $15, the stock price. If the current market price is $10, it doesn't make sense. The options are not in the money, right? It's cheaper to buy the shares on the stock market rather than from the company. So the executives will not want to exercise their options. So intrinsic value is 0. However, what is missing in that argument is even if when stock options have an intrinsic value of 0, there's still a certain option value. And that option value is the fact that you can wait for a certain length of time. These options expire usually many years from the date of grant, right? They might take a while to vest, but even after the vesting date, there's usually 2 years or longer before the stock options expire. So it gives these people, the holders of the options, the ability to wait and see if the stock price goes up. So the stock options could get in the money at a later stage. And so that optionality has a value. Even when intrinsic value is 0, there is a positive option value. That's to take into account future volatility in stock prices, time value of money, et cetera, beyond the scope. Usually an options pricing model will take everything into account. So many years ago, 30 years ago, 1993, the Financial Accounting Standards Board in the US first attempted to require expensing of stock options. Huge pushback from management. The attempt had to be withdrawn. And then this is kind of dated now as per the the textbook. Current accounting standards really have gone ahead, and we do require the expensing. So what was the the concerns that people were expressing? The basic pushback was on the count that, hey, we need these stock options as a way to reward our employees, our top management employees. If we don't offer them stock options, then they might leave the company for some other company. If you require expensing the stock option, shareholders of the company are going to protest. They're going to say, because Any expense, you think about it, if I'm expensing the stock options, the automatic result is my net income goes down. Even though there's no cash flow impact, if I expense something, my net income goes down. My net income goes down, earnings per share has gone down. Earnings per share goes down, the perceived financial performance is lower than it otherwise would be. That has an impact on the stock price. Stock price goes down, investors might not want to invest money in this company. The required rate of return might go up. Stock price goes down. The repercussion is that the required rate of return goes up. That might dry up the available capital for the company to invest in future projects. If the company cannot grow, the stock price will go down even further. Bad things happen. Plus, if you say we stop issuing stock options, well, we will start losing our top talent. These CEOs and CFOs will go to some other company who are willing to give them those additional compensation elements. So it was kind of a chicken and egg. There were like a lot of scare tactics. There was a lot of this hot air where like it became an issue of, if we do this, we're all heck is going to break loose. Over time, the standard setters did push through. And what ended up happening is now it's industry practice. Every company does it, right? So I guess the pushback is often, people are concerned if we start expensing and the others don't, or we stop using stock options as a means of compensation, and the other companies don't, we'll be at a disadvantage. So usually, like, you need a standard that is pushed through across the board, right? Across the board, it should hit all companies, and there should not be a choice. Had the standard setters left a choice between expensing stock options and not, no one would have wanted to expense. But when you remove the choice, everything's okay. Now, there has been some research done on stock options, and some research indicates that people don't usually wait until the end. People will exercise their stock options early. So if that happens, then um, the option value takes into account the estimated time to exercise. So if the options theoretically have 4 years until the expiry date, the valuation model will take that into account. But if most people exercise their options early, then only a shorter time frame should be taken. And if you take a shorter time frame, then the stock option value would be smaller as opposed to what is estimated by the options pricing formula, the Black-Scholes or the binomial model. So these models, an allegation is that these models overstate the fair value of the stock option, right? It's a very technical argument, and it can be responded to by adjusting the inputs. What have managers done to increase their stock option value? There is strategies called pump and dump. You may still hear allegations that managers will talk up the share. They'll leak reports about, oh, exciting things are happening, going to happen soon, etc. Pump up the stock price, sell their shares, and then that's the dump part. Pump up the price, sell their shares, that's the dump. After that, the stock goes down. So Kyle and I are both invested in a company called CMC, Cielo Waste Solutions. That is often an allegation against that company that from time to time, the management will release some news into the media and people get excited. The stock price goes up momentarily and then again it falls. We don't know what's happening. There's other companies that are doing kind of similar things. Maybe whether they're doing it intentionally or not is hard to say, but there has been research, at least in the past, before there were limits imposed on insider trading, where managers would resort to this, right? They would leak positive news stories to just increase the stock price value, sell the stock, sell their shares at a high value, and after that, the stock price would fall down. Or let's say if they were looking to buy more shares, they would release negative news so as to depress the stock price. And then, after that, they would go and mop up the shares. So that's something that management at Canaccord was trying to do. We don't know what's going to come out of that. There were other things that managers tried in the past: spring loading, late timing. So that's backdating the award dates. None of this is now allowed. So, I wouldn't even spend time talking about it. It's historical. That's what happened. Those were some of the abuses that occurred in the past. So why was there a pushback from managers about stock option expensing? Maybe managers did not believe in markets being efficient. Maybe there were contract-based reasons. That is more likely, right? So if you expense, as I explained, expense stock options, net income for the company will go down. Lower net income would be seen as poorer performance. It will have an impact on debt covenant ratios, and that can have a cascade effect in terms of poorer performance, higher cost of capital in future. So most likely, I would say the objections came from that side. All right, looking at the time over here, it's showing up as 7:38 p.m. So I've overshot a little bit with regards to our usual break time. Um, what are your thoughts on taking a bit of a breather? Kyle's good with the break, and others as well. All right. So it's almost 7:40 then. How long should we go for a break? 10 or 15? 10? Okay, let's do 10 minutes. Let's try and come back at 7:50 then. And I promise to wrap things up by 8:30 tonight. Okay? So 7:50, we'll have another 40 odd minutes and we'll wrap it up. All right. So far we've looked at the efficient contracting approach to decision usefulness. And the broad story is that um, you want to use accounting information as input in different contracts that a company engages in order to be able to negotiate those contracts and to make sure that there's as little friction as possible. We make a case for allowing managers some flexibility in the form of accounting policy choice. But we did acknowledge that when you give people the ability to choose, very often people will make choices that are in their best interests. And those best interests may not always align well with interests of others who matter. For example, shareholders or creditors, managers may sometimes end up taking decisions that promote their welfare over or at the cost of uh, the best interests of the shareholders and creditors. So that raises the question, is it really about efficient contracting or is it about managers acting opportunistically? Opportunistically is basically you're seeing this in a negative light, that these are people taking the opportunity to promote or enhance their own well-being. So this exact issue was studied under positive accounting theory uh, many years ago. This uh, body of thought came in the late 1970s. And there were three, and the beauty of some of these theories is that they're so simple and commonsensical. that you go, yeah, that makes sense. So positive accounting theory, or PAT, PAT, um, it in contrast to other normative accounting theories. So the distinction between what's positive and what's normative, a normative approach talks about how things should be. And whenever you have people describing or commenting on how things ought to be, like a normative approach towards accounting would be where a theorist would tell us how accounting should be done or ought to be done. You can always have others with a different worldview. So, what proponents of positive accounting theory, Watts and Zimmerman, basically came from the University of Rochester. So what these guys said was, hey, we don't know what the best way of doing accounting is. But what we can do is describe how accounting is being done. So a positive accounting theory, it should not be seen the opposite of positive here is not negative, right? The word positive over here is used as a way of sort of saying we are now telling the way things are, right? Rather than the normative approach, which describes or prescribes how things ought to be. Rather than saying what should be done, positive accounting theory attempts to describe how things are currently. And the implication is that by understanding how things are, we can then predict what will happen given um, certain inputs. So in this context, positive accounting theory is concerned with predicting companies' choices of accounting policies and how they will respond to changes in accounting standards. And positive accounting theory was structured around three basic hypotheses. They had the bonus plan hypothesis, debt covenant hypothesis, political cost hypothesis. And over the years, a lot of empirical research has been done, and it has found evidence that is consistent with these predictions. So, what are these hypotheses then? The first one is the bonus plan hypothesis. So, what does it say? If a company has a bonus plan under which managers are paid a bonus based on net income. The higher the net income, the higher is the amount of bonus paid to the managers. If there is a company that has such a bonus plan, we will find the managers working for that company to choose those accounting policies and to support new accounting standards that will result in a higher amount of net income being reported than normal. And let's say if there was a time frame involved, they would pick accounting policies that will report a higher net income in the current period than in the future. Because, if you report higher net income now, you get paid a higher amount of bonus now rather than in the future. That's commonsensical, I hope, right? So if I could get paid a bonus, I would sooner receive a higher amount of bonus now than in the future. That's your bonus plan hypothesis. So these managers will try to shift net income from the future periods into the current period. Try to report a higher net income now because the result will be a higher amount of bonus received by these managers. Okay, does that make sense? If there is a bonus plan, managers will prefer accounting policies that will report a higher amount of net income in the current period than in the future. The debt covenant hypothesis speaks about a company that has debt covenants in place. So when a company has debt covenants in place, the closer that company is to the point of being in breach of that debt covenant, you'll find the company's accounting managers will try to choose accounting policies that will help them avoid breaching that particular debt covenant. And usually with debt covenants, you can avoid the breach or violation of the debt covenant by reporting higher net income, right? I mean, think about it. If you have a debt to equity, right? Higher net income will mean higher equity and a lower debt to equity ratio. Lower debt to equity ratio is good. Interest coverage, the higher is the amount of net income, the higher would be because you calculate the interest coverage ratio in terms of earnings before interest and taxes. So if you're able to improve your earnings, your interest coverage ratio will be higher, which is good. So in either case, you'll find that managers of such companies will prefer accounting standards that will report a higher amount of net income in the current period than in the future. Again, consistent, if you will, with the bonus plan. All right, so bonus plan, the managers are choosing the accounting policy to increase their own bonus. Debt covenant, ostensibly, you could argue, the managers are choosing the accounting policy to make sure that the company avoids violating the debt covenant. So if you find managers picking accounting policies, can you say for sure that the managers are acting in their own personal interest, i.e. a higher amount of bonus, or are they trying to get for efficient contracting, right? Trying to avoid having to rewrite a contract because of a violation, and therefore, trying to avoid the breach by reporting a higher net income. That's what was being raised, right? So it's hard for us to tell the motivation of the managers in choosing the accounting policy. Compound that with political cost hypothesis, and you're looking at something really interesting happening. Here, you could have a company that either as part of an industry, broad industry, or the company specifically is under a lot of scrutiny from either politicians or the media. So think about the retailers like Loblaws, etc. Like Loblaws, for example, reported net income of over $550 million. And there's a big hullabaloo out there saying, oh, Loblaws, the company that owns Superstore and others, grocery stores, like these guys are making obscene amount of profits and they're profiteering from inflation in the name of inflation. They've raised the prices of groceries so much that the groceries are now beyond the reach of individuals, etc. And inevitably there is an inquiry placed, where politicians of all stripes will form a committee and they'll ask for representatives of the grocery companies to come and explain why they're raising prices of grocery items so much, etc. Usually there is some kind of charade like that. Oil and gas companies, whenever oil and gas prices shoot up quite a bit. So when you have something like that happen, right, when especially there's a lot of scrutiny, there's a lot of um, and there's a backlash basically, right? Because people are suffering and people are looking for something to blame their suffering on. And, if the media highlights your company or your industry to be part of the problem, then there is likely going to be a backlash, right? When you have something like that happen, often companies will then, or managers of such companies that are under a lot of media scrutiny at that time, they'll choose accounting policies that will delay net income. So they try to pick up accounting policy that will lower the current period net income and push that income back into future periods. So rather than report higher amount of net income now, push that net income, right? So try to speed up expenses and so on, just kind of reduce the current year's reported net income, because the more, and that would be sometimes the times when companies will write down huge amounts of impairment losses, restructuring charges, etc., just to clean up their balance sheets so that in future the numbers would look good, but for the time being, just suppress the fact that they have high net income otherwise, right? Reduce the amount of reported profit because they're facing political costs in the form of just so Joe Biden, the U.S. president, was talking about oil and gas companies reporting super high profits. They were talking about charging additional taxes, because they say oil and gas companies are benefiting from a windfall, right? Because of the Ukraine war, for a while the prices were very high, and so the argument went that these companies are reaping benefits of geopolitical events outside of the industry norm, and so therefore these companies should be subject to higher rate of taxes. The higher rate of taxes doesn't help anyone, right? I mean, one couldn't um, justify paying the higher costs, higher taxes. Especially managers don't want to pay the higher taxes because it lowers the amount of EPS as far as shareholders are concerned. Higher taxes don't benefit the shareholders. Higher taxes don't benefit the managers as well. So what managers will often do in these circumstances is report lower net income. So in a nutshell, if there's a bonus plan, managers will try to increase reported net income. If the company has debt covenants, regardless of whether the company is close to violation or not, the company will prefer higher net income to lower. But when the company is faced with political heat in the form of greater scrutiny from politicians or the media, they will try to reduce reported net income. So looking at opportunistic versus efficient contracting, managers will usually try to maximize their own utility. Their own utility often is in terms of the personal compensation they get from the company in the form of salaries, bonuses, etc. So that being said, when managers make choices about reporting policies, it is possible that they might not be acting in the best interests of the shareholders. If they are not, and we can clearly see that as the case, then we would say that the managers are acting opportunistically. The problem, though, is if I go back, it is very difficult when I look at a company that has a bonus plan and has debt covenants, when we see managers acting or trying to increase the current period net income, making accounting policy choices that increase the current period net income, it's very difficult for us to say whether the managers are doing to enhance their own bonuses or whether they're doing so to avoid the violation of debt covenants. That uncertainty is usually the reason why we see a continued incidence of such opportunism being there. What's the evidence? Research finds support for both views. There's a bunch of papers that your textbook describes that support the efficient contracting approach, that managers take accounting policy choices that help ensure overall efficient contracts, but there are also studies that have found the opposing view to be supported. Who's to say? Who's to say? Things are muddy. right? Things are murky. Implicit contracts, I've talked about it. It's basically where a company will take actions that go beyond basic legal requirements. And in an IFRS world, that's called a constructive obligation. Linking implicit contracts with game theory. Game theory is a branch of economics that was developed in the 20th century, quite a lot again during the Second World War time. Um, and you can have games that are non-cooperative, cooperative. In a non-cooperative game, you have rational parties who are um, looking at the other player as a thinking opponent. And so they make choices taking into consideration what they believe the other party is going to take. So it's almost like a game of chess. When you have such a game, a non-cooperative game, we might sometimes end up with the Nash equilibrium. It's named after its a proponent, John Nash, who did work during the Second World War. You may have seen the movie A Beautiful Mind, starring Russell Crowe as John Nash there. If you haven't, good movie to watch. The Nash equilibrium is it's basically a strategy pair and a choice basically in which it's the outcome that is predicted where the game is only played once. So when you have a single play round of play, we sometimes end up with what's called the prisoner's dilemma. And you may have heard of the prisoner's dilemma, you might not have, I don't know. But there is a short video that you can watch about the prisoner's dilemma. I think it's about 7 to 8 minutes long. And I would actually recommend that you take some time to watch it. Okay, good people. Hopefully you were able to watch that video. I played the video at my end. I don't know how good it came out, but the link is there in case you didn't catch the video. You can always watch it again. And it's what really it tells us is that when you have an absence of trust amongst the parties, what we end up with, the final outcome that we end up with, might not be the best outcome for any of them. If each party tries to maximize their own personal well-being, the overall outcome, because now if you think about for a company, um, if we know that the managers of the company are going to somehow try to maximize their own personal well-being, it could result in other parties who are at a disadvantage as far as information is concerned to withdraw, right? The lenders might stop lending money to the company. Investors might stop investing in the company. And where does that leave the managers at? If the company runs short of available resources, it's not going to last for long. So when you have something like that happen, quite often there's a lot of friction in the form of, you have to overcome the trust deficit, you have to get extensive audits done, et cetera, which is at the end of the day, it costs money, resources, time, etc. May not be the best outcome. When these games are played over multiple periods of time, though, when you have people spend time with each other over the longer run, then we could see some kind of trust pattern emerging, because people then realize that it will be in their best interest if they cooperate rather than simply try to maximize their own personal, narrowly defined self-interest. And so, based on that possibility, an offshoot of game theory has emerged over the years, and that is what is called agency theory. Right? So we will be looking at the context where within an organization, managers can be seen as agents working on behalf of shareholders who's the principal. So because managers want to be employed by the company, by the firm for a longer period of time than just 1 year, and because shareholders themselves are not able to put in the extensive time and effort needed to run the company, they are both motivated to somehow thrash out contracts between the two of them, the two parties, so that the interests of the agent, the manager, is aligned to that of the interests of the principal, which is the firm owners, the shareholders. Likewise, you'll see lending relationships, like lending contracts, where the principal, being the bondholder or the banker, can be aligned with that of the agent, which is the company's manager. We'll see more of that in action in the analysis of conflict, which is the subject matter of chapter 9. So finally, to summarize the discussion that we've had so far with regards to efficient contracting, how does that matter for us in accounting? When we study efficient contracting, it raises, or we are able to see that it raises two very important questions as far as the conceptual framework is concerned. Currently, verifiability is seen as an enhancing qualitative characteristic. So the question is, should we leave it? Should the standard setters leave verifiability as just an enhancing characteristic, or should it be elevated to the status of a fundamental characteristic of qualitative information? Maybe make it part of faithful representation. And then secondly, when we talk about financial statements providing an early warning system, we require an overemphasis on an overt emphasis rather on conservatism. Conservatism itself is mentioned in the conceptual framework, but it's not part of any explicit qualitative characteristic discussion, right? It's something that you want to aspire for, ensure that we don't end up overstating assets or liabilities. But is there room for conservatism as a means of an early warning system for bondholders or debt holders in general to indicate a company going through financially troubled times? Should that be formalized? So those are two important questions to consider. And by analyzing non-cooperative game theory, we are able in general to model the conflicts, the situation of conflict that inevitably arises when you have a corporate structure, corporate form of organization where the resources are owned by the residual claimants, the shareholders, and the lenders, whereas they are managed on a day-to-day basis by essentially people, the managers are essentially employees, right? Even the CEO is an employee of a company. And however, these employees are in a much privileged position because they've access to more timely and superior quality information than the owners or the resource providers. And so that inherent information asymmetric situation, especially, the moral hazard that it poses, can cause a fair bit of conflict. And that's going to be the discussion